to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com. Now, here's Phil.
Well, the market got a surprise today. People are really getting confused over the $40 billion that Powell said he's going to use to start purchasing treasuries with. But there's a big difference between when you're buying long-term 10-year treasuries than there is, buying short-term Fed rates. So what happened yesterday, people were assuming that, hey, this is going to be the fifth QE. It's going to be great but all they remember about QE is the stock market keeps rallying. Companies, again, purchase their own shares. And so all good. The bad part, of course, is it's all phony. And one day you end up paying for it. In other words, it means that one day you've got all this inflation. You got to fix it. And so QE is really, if you think of QE, it's just a bubble maker. And it works perfect for Wall Street because that's Wall Street's job. That's what they do, create bubbles. And the interesting thing that people don't understand, and I showed it today, that when they buy a stock, if you remember Enron, what happened to Enron, right? We had, first of all, the dot-com bubble. Wall Street, they will induce that bubble. They will pump that bubble up. They will push liquidity into the market. They increase the money supply. That's their job. They try to get rates down to as low as they can. It's to create a bubble. That's how they make their money. And we've had bubbles since the tulip era. That's how they make money. And what they do when they create these bubbles, they make a ton of money on both sides. So in other words, if you have a stock that's going from, let's say, $31 up to $200, that stock, they're going to push that stock up by printing money, buying treasury. It doesn't matter if it's 10-year treasuries, long-term, or it's short-term T-bills, 1 month, 2 months to a year. They do pack a different punch, but only a professional would recognize it. So in other words, QE, with 10-year treasury use just has a bigger sledgehammer, or a bigger rocket. If you're doing QE with short-term T-bills, it's got a smaller rocket. But most people won't sense the difference. So let's just talk about these. So when they create these bubbles, and the way they break the bubble, and to keep the next bubble going, it's just fascinating because people over all these years still don't understand it. And if they understood it, how they inflate bubbles on purpose. They run them up, pop them, and come back down. But what they don't get is Wall Street has been able to take parking space in the heads of investors, of retail investors. Now, these aren't tourist investors, okay? Tourist investors are different than a retail investor. FOMOs are different than a retail investor. A FOMO investor is just, he's just nuts. They'll buy, they always buy late, they always buy at the top. They buy everything on emotion. They're the people who sit in front of the TV and someone gives a stock out, they write it down and they buy it. FOMOs just always buy at the very peak. They're always losing money, but they always come back for another beating. Now, the tourist investor, he's a little smarter, not so much smarter, but he doesn't have that kind of emotion, but he does have plenty of emotion, and the tourist investor doesn't want to learn. He doesn't want to go in a class. He doesn't want to know what stochastics are. He doesn't want to know anything. He just wants to get a hot tip. He's the guy that runs around, hey, you got a hot stock? What stock do you think's going up? Hey, is this stock going up? What do you think? Should I get this stock? Those are tourists. They'll never be able to sit down and say, well, let's see, let me go through my stocks here. Oh, I can see why this is a good one. This would work. And what makes a good stock? Money. There's no such thing as a hot stock or cold stock. If money is driven towards your stock, it's going to go up. If money is driven away from your stock, it's going to go down. But when you decide, I'm not going to learn how to make money when it goes down, I'm only going to make money when it goes up. So what Wall Street's saying to you is, think of your stock as a car. And you got to keep parking your car on a busy street. But you're not going to have reverse. So when you got this tight little, we've all gone into tight parking spots, right? We're always worried we're going to hit the guy in the back or front. But you got to do it. Wall Street plays the game where you have to agree that you're such a good driver that you can drive to perfection, that you don't need reverse to get in your parking space. You only know how to, all you need is drive to go forward. 90% or 93% think that way, that they don't need to know anything about, they don't need drive with their car. I mean reverse, they don't need reverse, it's just ridiculous, just extra cost I don't need. That's the mentality. That is the tourist investor. I can park this car without reverse. I can trade stocks without shorting. It's the same exact mentality. What are you, nuts? It's the same. So the bubbles are created through increased money supply. They need stimulus. And you have stimulus that comes from purchasing treasuries. Now, let's say you buy it, but we had the dot-com bubble, right? Went up, peaked at the top, the FOMOs got in the top, and the market went down, I think, was it 40%? They lost all their money. 401ks lost all their money, but that was the first bubble. They get into the second bubble, the housing financial bubble. They push that bubble up. Wall Street pushed that bubble up. And then they pull the plug and the bubble went down. And then they've done another bubble and another bubble and another bubble. They keep doing bubbles and it's just nice that people don't catch on. And especially if you know how to sell short. And that's how Wall Street thinks. Well, I've convinced all these people not when they're going to park their car, they don't need a car with reverse. So here's what they do. So if they start out, stock's doing well, the stock's at $100, stock starts going up. What is it that have you ever noticed when you look at recommendations, what are the you ever see sell recommendations at all? Or do you mostly see buy? It's always buy, isn't it? So when the stock goes from 100 to 200. Now, Wall Street's made a ton of money, right? Because first of all, they represent, who do they represent? Wall Street's been designed not for retail investors. Retail investors should never be in Wall Street, okay? It's never been intended to have retail investors at Wall Street. Wall Street was always designed to raise money for businessmen to create business, to grow businesses, to employ people. That's what Wall Street was always for. The purpose of Wall Street was a money center where you can go and borrow money. You got a good idea, great idea, and I want to build this idea. I want to build my business, but I don't have the money. I can't go to the banks. You go to Wall Street with a great idea, you get funded. And they'll fund that idea. And then when that idea catches on, they're going to go in and fund the hell out and make it a big bubble. That's what they do. Now, once a stock goes up, for example, we're up, I think, over 1,200% right now in the S&P. I'm pretty sure it's around 1,200%. The bubble we're in now, it's up 1,200%. The NASDAQ's up 1,200%. So we created a bubble up 1,200%. The S&P's up, what's it now, about 450? 8. So the S&P bubble is up 800%. We've never seen bubbles this big. If anyone thinks the 800 bubble is going to go to 1,600, 2,400, 3,000, if they think the tech bubble is going to go from 1,200 to 2,200 to 6,200, and they do. They do. The majority of traders, I'd say 99.9%, believe they're just going to keep going up because in their mind, all they've seen, because most people don't remember the crashes. They don't remember the crash. How many people remember the crash of 1937? Not very many people, right? How many people remember the crash of 1974, the 35% crash where everybody got wiped out? Very few people remember that crash. And how many people remember the crash of 1974, and the next one was 2002. Very few people remember 2002 even. But those are bubbles. And the guy who started the bubble in 1931 decided to pop it because they made a tremendous amount of money on the way up. Now they're going to make a lot of money on the way down by shorting it, but who do they get out? Who's the people they get out? Who's Wall Street get out? First of all, the people they put in is institutions. So JP Morgan, Goldman Sachs, Citibank, all these guys, the 5 biggest brokerage, commercial people, gangsters, they all compete for the same customer. They all compete, not for the retail customer. They just put them in 401ks and leave them alone, let them lose money on every crash. They compete for the steelworkers union. They compete for the police union in California, the police union in New York. They compete for the big pension funds. That's where they make a fortune. And the 5 biggest banks on Wall Street, all competing for about 10 pensions. And it's a brutal competition. So they cannot let any of their clients, I'm talking about the unions, I'm talking about the pensions, lose money. So when the stock market goes up from 100 to 200, it's time to pop the bubble because they want to create a new one now. So they have buy, all the way up, buy. You hear Kramer all the time, buy. Everybody's got buy. If you look, let me look at the recommendations. There's still buy, oh God, there's still buy. I'm going to buy more. There's more buy. Oh, look at this new buy recommendation. Oh, this is a strong one. Then when they pop the bubble, they tell their clients, the biggest clients in the world, we're going to get you out right at the peak. Who buys at the peak? The FOMOs. You need the FOMOs to buy at the peak to hold that market up. And they always buy at the peak. Now the stock starts going down. Now if the stock went from 200 down to, let's say 200, went from 200 down to, I don't know, 185. And then it went down to 165. Wouldn't you think they would change the buy that they had always in from 100 up to 200, all that strong buy, strong buy, don't you think they start changing it to a sell? But they don't, because on the way down, remember, they want to pop this bubble and get going again. They make money, more money when they pop the bubble shorting. So on the way down, they need you to keep the bubble up, because if they put a sell signal when the stock went from 200 to 185 and they put a sell recommendation, the stock market would drop within an hour. It would go from 185 to let's say 100 within 30 minutes. Then all these big institutions they'd lose all their money. So they need you, the retail customer, to keep that bubble up. How do they do that? They do it by taking parking space in your head. What's a good idea is that you buy, when your stock goes down, cost average down and buy more of it. And when the stock goes from 165 down to 100, buy even more. Buy on that dip. And they do this all the way down, like Enron, all the way down until the stock from 200 is now down about $15, like Enron. It was even less than that, $5. And you have to ask yourself a question. Well, why didn't anybody, Goldman Sachs, JP Morgan, why didn't any of them change it from a buy to a sell? Why did they change it to the sell when it got right at the bottom and the stock wasn't, it went from 200, we'll say, down to $5. That's where they changed it as a sell. Why would they wait there? Because remember, by getting those people out, they got $25 million waiting now in new cash. They're going to take that cash and put it back to work. Where are they going to do it? I'll tell you when I get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When making wise investment decisions, Phil Grande has some sound reasons you should join Phil's gang.
You know, when I started this, they asked me, okay, can you explain to people why they should join the gang? Gee, I thought about that. And I guess to make money. But more than that, to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com. Welcome back to the Phil's Gang Radio Show. Want to know more about Phil's Gang? Go to philsgang.com. Or give us a call at 877-600-4264. Now, here's Phil.
And welcome back. So now, JP Morgan, Goldman Sachs, Citi, Bank of America, Wells Fargo, they have made, for their clients, they got $50 million. And it's sitting over here in a big checking account, or no, in money. They always put everything in money markets. That's why, again, they always keep the money markets up. That's the most important thing. That's why they buy T-bills, to keep the money markets up. Anyways, $50 million sitting over here now. They all made money. You, the retail customer, lost money. Your 401k lost money. It was designed that way. Because you, if you take a look, if you can see my chart here, I got the Enron chart up, just take a look at it. When Enron was at $35, they had to buy. And they keep telling you, every time it pulled back on a dip, buying a dip, buy. But that was okay because we had an uptrend from, let's say, $35 up to 90. We had a beautiful uptrend. That's where you buy on dips. Makes sense. But then it went from $90, $95, it dropped down to $77. That was crucial because that's where it broke all support. And the support was gone. Instead of being underneath you, it was on top of you to push the stock down. So now the stock at $62, they recommend buy. You look it up, everybody's got a buy recommendation. Everybody, Goldman Sachs, Citi, buy, strong buy. But the stock dropped from $90 down to 65. But they didn't change it, did they? Why? Because they convinced the retail investor, okay, the tourist, to go in now and buy. If you bought that stock at 90, it's really good. It's got to be really good at $62. So now you go and you buy it at 62. They call it cost averaging down. What did that do? That kept the stock up. Now, the 5 big gangsters have just made a bundle of money for their big clients, institutions, big clients, not retail. So you bought on the dip around $65. Now the stock goes down again. It hits 45. Well, they can't let the stock go down because they got to get more people out. So now they tell you, buy in the dip, buy at 45. We got a strong buy. But wait a minute. It was at 90 you had to buy. It's at 65 you got to buy. Now you're telling me to buy it at, here it is right here. You're telling me to buy it at 50? Yeah, buy in the dip. It's hard to find stocks like this. Buy in the dip. You can get more of it. Cost average down. Then boom. Now they got more people going out. Okay, Morgan Stanley, Goldman Sachs, Citi. Now everybody's making a bundle. The steel workers are making a bundle. The Chicago Police Union is making a bundle. The construction workers in New York are making a bundle. Their union. Now the stock keeps going down because guess what? The union money's coming out. So now it goes down to, let's say, 55, right? Now it goes down, it went down to 45 right there. I'm watching it where it went down. If you can see this, it went down to 45. They had a big buy signal there too. Buy. Buy in the dip. So everybody is buying on the wrong side. They're buying on the dip. They're buying on a downtrend. It's like a plane is crashing. The engines are gone, and you ask the stewardess calmly, could I have a martini? And, when are you serving dinner? They have no idea what's going on. All the guy knows is, wait a minute, I remember I bought the stock at 82. Now I'm buying more of it. You're telling me to buy more of it at 50. They got to know what they're doing. Now it gets down to $35 Enron. And I remember this. Everybody's buying on a dip again. Kramer's got everybody buying. Here, I got it right in front of me right here. But what the key is, we had all buy recommendations from $37 up to 90. And then it went from 90 down to 75, down to 65, down to 55, down to 45, down to 35. They had the same buy recommendations. They even moved them up to strong buys on the way down. Now all the boys are out. The 5 biggest gangsters got the unions out. Now there's in a pot, $50 million in cash. The 401ks lost most all their money. The retail investors lost his money. The only people that made money was Wall Street and the big unions and big institutions. Now, here's the key. When Kramer came in and the stock was at 35 and went down to 25, and remember, the stock was at 90, he says, if you don't buy this stock now, you are a fool. Buy on this dip. Why did he do that? He's trying to help his boys on Wall Street to get everybody out. Now it's out. What do they do? Now it's stage 6. We call that the panic stage. Now they pull their bids out. Boom, because they got everybody out. And there's 50 million in a pot. Now they finally, when the stock gets down to $2.50, they change it to a sell. Oh, I see. So at 90, there was no sell. They didn't change to a sell 65, 55, 50, 42, 30. No, they kept a strong buy, strong buy, strong buy. Now a sell? It's $2.50? Why did they do that? Well, because they want to scare anyone that's left. If there's any buyers in there or any sellers in there, they want them out. Get them out. Because now they're going to take the 50 million, come in, and they're going to buy all this stock, or not this company because we're not out of business, but then they're going to go and buy another stock of a company, and then they start the bubble again. Now the bubble starts going back up again. That's what Wall Street does. It creates bubbles. You're not invited to play. When they took your pension away and put you into a garbage 401k, it was over for you, the retail customer, unless you know how to short. They took your professional, the person's watching out for you, who was making money only if you were making money. He was managing your pension account so that you could retire, have a great retirement. And what did he do? Took him out, and they put in somebody who doesn't know what they're doing. And they finally got rid of all the pensions, put garbage 401ks, which was nothing more than a piece of, it was a tax code. The CEOs were using it. If I was CEO of a company and I just got a $80,000 golf membership at the Oaks Club or somewhere, so I wouldn't have to pay tax on it, they put it in the tax 401k. Then they said, we could screw everybody by taking that 401k, and we'll tell them they could be a Warren Buffett. What we'll do, we take the mutual fund industry, which is rotten to hell. They're worse on Wall Street. Nobody even knows who they are. They don't even make any money. Let's go to them and tell them, hey, we'll buy all your garbage. And by the way, my company and your garbage, we'll buy your garbage. We'll partner up. So we make money at the company. So that's what this is all about, bubble to bubble. That's okay. People are accepting it. They've been accepting it for years. Retail investors have been accepting losing money for 50 years. 93% of the people in the market lose money. Why? Because they refuse to sell short, which is the easiest thing in the world. So it is bubble after bubble after bubble, and they get away with it because they convinced you that a stock you bought at 80 and now is at $5 is a hell of a deal. So, once you learn how to short, you're on the other side. You're on their side. You're on their side. That way, when somebody asks, what do you think the market's going to do? You yawn, I don't care. Doesn't matter to me what it's going to do. That's not the question you should ask me. You should ask me the question, when the market starts going down, what are you going to do as it goes down? Do you have the talent to sell short? Your car still just have forward with no reverse? Are you still with the broker that told you to buy a car with forward, no reverse? And that you can trade so well to perfection, you can get in every parking space, no problem. Good luck. So the bubbles keep on going, and that's what we're in now. And now there's a panic. And the panic is that the banks are in big trouble. And boy, they've masked it. The banks are in big trouble. Remember, the stock market, the economy, banks are only as strong as the reserves. We used to have reserves in banks of $45 billion. I'm sorry, I was getting billions with the trillions. Trillion. Today, in the banks right now, you know what the reserves are? They got a mandate of $3 trillion. $3 trillion. It used to be $45 trillion. Now it's only $3 trillion. They can't even keep that up. It's at $2.5 trillion. $2.5 trillion. So there's a panic. There's something wrong on Wall Street. So what they're doing, they're buying short-term T-bills. And they're telling people it's not QE. It is QE. So why are they buying short-term T-bills? Because remember what their goal is. Their goal is to get in and boost those reserves up. That's their big thing. Increase the reserves, the bank reserves. They're panicking over the bank reserves. Because that everybody that lies to you is, oh, don't worry about the $600 billion in losses. Those are all make-believe. No, they're on the balance sheet. They are real. And because we're below the reserve, he is panicking, Powell. He knows anytime, if he doesn't get the reserves up back to $3 trillion, which he just did, that can change over. That 600 and unrealized bank losses are reclassified as 600 billion, and you're going to have the same thing that happened with Silicon Valley Bank, First Republic, Signature in 2023. Now, so the idea is they're buying T-bills, and he says, well, I'm not, he says, it's QE. It's QE. And yesterday people think, oh, this is QE. I'm going to get out of all my discretionary stocks. I'm going to get out of my Coca-Cola. I'm going to get out of all the discretionary stuff, and I'm going to go back and buy NVIDIA. Because these guys they're all addicted to NVIDIA anyways. They're all addicted to the same 10 stocks. But because they were told it was a QE, they're jumping in left and right. But you're right. If you buy a 10-year Treasury yield, or you buy a 1-month Treasury, they all have the same effect, except they don't have that punch. They don't have that same punch. So everybody got out of their safe stocks yesterday, the stocks they should be in, and they went back to tech, and today they lost their shirt. T-bill purchases only affect, remember, short-term spendable cash and reserves in the banking system. In other words, when the Fed buys T-bills, it's increasing the cash, the fuel that the banks need. And think of it, it's just like part of the operation. It's operational. It's not, when you buy T-bills, when the Fed buys T-bills, it doesn't stimulate. It doesn't stimulate. If you buy a 10-year Treasury, its job is to stimulate. If you buy short-term T-bills, Powell, it doesn't stimulate, it covers their butt. It increases the cash they need. It increases the cash and reserves in the banking system, which you need. Because again, your banking system is only as strong as your reserves. The economy is only as strong as the banks. So they're panicked. The next thing they're panicked about is repos. They don't have the money for repos. So now they got to fix the repo market, because every time the banks, at the end of the night, banks used to lend to each other. Now they can't lend to each other. They don't have the money. Well, Powell turns around, goes and buys a whole bunch of short-term yields, which is dangerous from one point of view, because if you buy a 1-month Treasury, you buy a 2-month Treasury, 3-month Treasury, when those roll over constantly, and in one morning you can wake up and that thing has spiked so high.
1 minute.
Spiked so high. The yields have spiked so high. So the tourists, the FOMOs, are thinking we're doing another QE. The results are going to be the same as the other 4 QEs, but they don't realize only from an operational point. They're going to fix the problems right now. They're going to fix the repo market. They're going to fix the reserves that are too light. We need more reserves. But it doesn't lower your mortgage rate. Doesn't lower all these corporations who have $14 trillion in debt. They're not paying 1% anymore. They're paying 5 to 8%. People have no idea what's going on. They just, I'm going to go buy NVIDIA. I'm going to make a lot of money. But what they don't understand about NVIDIA, they can't buy their own shares anymore. Oracle can't buy their own shares anymore. Why? I'll tell you tomorrow.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.